Good morning again, everyone, and welcome back to Ivey Academy TV. We made this joke yesterday. It's still true. We've become reluctant broadcasters here. I'm your very reluctant talk show host, Mark Healy. Steve, we've already got a comment from the audience asking if that was you playing jazz or the snare drum. Maybe we'll come back to that. I'm the executive director of the Ivey Academy, the learning and development wing of Ivey Business School in London. Thanks very much for taking time out of your day today. We really hope you get some value today. Yesterday, we spoke to three folks really in the thick of the healthcare fight against COVID-19. Their insights were quite incredible if you got a chance to see them. Very focused on health outcomes. Obviously, I think if I took a couple of things away from their views on where we are and where we're going, keeping people at home is working. It's maybe the only thing that's working in terms of preventing surges. The healthcare community will continue to advocate this continues. And obviously their comments were focused on healthcare and not on the economy or economic recovery. We know that for our communities, keeping people healthy comes first. We've heard that, loud and clear from lots of feedback. That said, we have an awful lot of folks worrying about recovery. And overall, for their businesses, and of course, if we're honest, for themselves and their own portfolios and their savings. Aren't we all worrying about that after all? So our own Dr. Stephen Foerster is with us today. Steve likes to remind us all the stock market is not the economy, but the market matters to all of us. It's a signal of market sentiment about the future, at least theoretically. We'll probably talk more about that today. And it holds the keys to our personal wealth. We've gotten a ton of questions about how to make sense of the stock market. Steve's kind of our go-to guy on this. Steve is a professor of finance at Ivey Business School. He's taught here since 1987. He was my finance prof back in the day. He received a BA from Western and an MA and PhD from Wharton at UPenn. He's now a CFA and has taught financial management, investments, and portfolio management courses in basically all of our programs. He's won numerous teaching awards, written 2 textbooks, over 100 cases, technical notes in areas of investments and financial management. He has over 50 publications to his name, including empirical studies in leading journals. As always, I'm going to moderate and direct traffic a bit here. We also have Sean Ackland-Grant with us. Sean's going to be our tech lead, as always. More importantly, he'll keep track of and curate questions in the chat and the Q&A. Normally, Sean and I would kind of come in with themes that emerge from everyone as we're going. We're going to do this a little bit differently today. We're going to kind of hold those toward the end. And one note, we're going to have a lot of quizzes and polls as we move through the session today. So Sean, could I go to you to talk a bit about how this is going to work and particularly about quizzes and polls?
Sure. Thanks, Mark, and welcome everyone tuning in from home. Another great turnout. If you've joined us for a past webinar, we know that we encourage you to get involved. You can do that in a couple of ways. First, at the bottom of your screen is the Q&A icon. If you click that, you can use it to submit questions or upvote other questions you like. We'll also be using the Zoom live polling, which Steve has requested be renamed the quiz box for today. So it sounds like any trivia brain teaser fans should get ready. If you're dialed in using the Zoom phone line option, you won't be able to see polls, so consider switching to a computer for that. We're also live streaming the broadcast on YouTube today. The full recording will be posted on the Ivey Academy blog, and we'll also send out an emailed link to everyone registered. Back to you.
Okay, great. Let's get going. Steve, you've called this lessons from history. So why a history lesson? Isn't it future that kind of matters here most?
Well, thanks, Mark, for the question. I wanted to start with a quote from Mark Twain. History doesn't repeat, but it often rhymes. And I'm really a firm believer that we can learn a lot from history. And so today we want to focus on stock market history, because everybody has a vested interest, either through direct investments or indirectly, perhaps through pension plans or both. Now, I certainly recognize that looking backwards isn't the same as taking out a crystal ball. I wish I had a crystal ball to look through, but I really think that that knowing what's happened in the past can really inform some of our investment decisions today.
I know you worry a lot about sentiment. Think about sentiment. How would you summarize the sentiment as you see it today?
Well, in a word, I would say scary. We live in really scary times. People are anxious. People are wondering and concerned about the health of their families and health of themselves. People are wondering, will I lose my job? Will I lose my savings? And so it really is a time of unprecedented disruption. And that's certainly manifesting itself in the stock market as well. Just in the last couple of months, we've seen some major swings in the stock market. And so really some of the questions are we headed for more losses? We've seen some rebounds. Are those rebounds real or are they imaginary? And so what I'd like us to do today is to pause, take a deep breath, and take a look at some evidence of what's happened in the past. And hopefully that will then inform us on some decisions we might need to make today.
Okay, great. Let's dive in then. Let's talk about the stock market itself. What's your view on stocks as a long-term investment?
Well, Mark, before I answer that, maybe Sean, if you could tee up our first quiz question and try to put things into perspective in terms of looking at long-term investment. So here's our first quiz question. So be ready at home. We'll have 7 quiz questions. You can keep track and see what your score is. For those of you who are graduates of the program, this is not going to retroactively impact your grades on any courses. So I want to be clear on that. Okay, so let's suppose you invested $100 in a diversified portfolio of US stocks in late 1927. So just to put it in perspective, that's just before the Great Depression and a huge market decline. And suppose you earn dividends of around 3%, which is sort of a long-term average of dividend yields, and you reinvested all of those dividends and any capital gains, how much money would you have today? We're going to do some quick polls, so we're looking for some quick answers. A, $1,855 from the $100 invested. B, $5,185. C, $18,550. D, $51,850. Or E, 185,500. So let's tee that up. And Sean, when you're ready, let's see some results.
Okay, so we've got about 60% voted so far, and I will say that folks have had a little bit of extra time with this poll, so it's going to be a good answer. We have our first piece of feedback back from the chat as well, which is that it was my understanding there would be no math today, Professor, says Jerry.
Well, sorry about that. You know, I can't resist. I just can't resist.
Okay, so we'll end the poll here and share the results. Let's see what people thought.
It looks like the majority said E, and E is the correct answer, 57%. For those of you who didn't answer E, perhaps not as optimistic. This really goes back to time value money and the magic of compounding. So let's close that up, and as we move to the next slide. Here's a chart that really puts things into perspective in terms of long-term investing. This is a chart looking at the S&P 500 index back to 1927, and we're focusing on the US market because we have the longest reliable, one of the longest reliable data sources for stocks. The growth rate based on capital gains over that time period has been around 5.5%, adding 3% dividends. That's 8.5% per year, and that's where we get the growth of that $100 to today of $185,000. If we had modified the question to say investing $100 each year, that amount of money would have grown to about $2.4 million. So back in 1927, the S&P 500 was at a level of 18, and it rose to a high point recently in February of 2020 of 3,386 before the recent setback. Now, it's interesting, in 1994, Jeremy Siegel of Wharton, one of my former professors, wrote one of the bestseller investment books of all time, Stocks for the Long Run. And I'd encourage you to take a look at that book. But here's a quick summary of it. Really, the anchor of the book is a picture similar to this, which shows on a log scale the increase in the stock market. And again, I want to stress, this is only the capital gains. We would have to add on the dividend components as well. And what's remarkable about this graph, I think, and again, the key is that this is in a log scale. What's remarkable about it is how relatively straight this line is. And what that implies in a log scale is that the rate of growth of stock market returns has been relatively stable for the past century. Yes, there've been lots of ups and downs, but over that long period, stocks have trended up pretty consistently. Curiously, 70 years before Jeremy's book in 1994, in 1924, there was a book by Edgar Lawrence Smith, and the theme was very similar to Jeremy Siegel's book, Common Stocks as Long-Term Investments. So if trends continue, perhaps 70 years from Jeremy's book in 2064, there'll be another bestseller on stocks as a long-term investment. Now, I recognize that's quite a long period for most of us in terms of what our investment career has been. So this next chart focuses in on the last 25 years. So if we just focus in on the last 25 years, what do we see? What do we see there? Clearly, there have been a lot of ups and downs over that time period. But again, we see even over that last 25-year period, a very consistent upward trend. So the other thing to note is that if you look at the recent pullback, and there's been a bounce back there that's hard to tell from this graph, really that recent market activity, market volatility has been just a slight blip in terms of this chart. Now, let me put it in a different perspective here to further this point. And here's another take on the ups and downs of the market. For Christmas 2015, one of my sons gave me this custom-made hat with Dow 20,000 on it. And at the time, the Dow was at a level of around 17,000. Just over a year later was the first time that the Dow exceeded the 20,000 mark. And that's this picture here with the newspaper article showing the Dow breaking the 20,000 mark for the first time. 3 years after that, in February of this year, the Dow hit an all-time high of just over 29,500. That was February 12th. 5 weeks later, what happened? The Dow once again crossed the 20,000 mark, but going in the other direction. So just to update this picture here, again, I've changed it a little bit here. So if we put a more recent photo, put the hat back on, and I've got the hat right here, and turn the newspaper upside down. That's sort of where we're at with this little mashup. But anyway, that's where we're at. Back to you, Mark.
Yeah, there seems to be a lot of fear in investors are experiencing. I can see it even in our Q&A and some of the questions that are coming in. You can feel it a bit. Is there a way to measure fear?
Absolutely, and it's called the VIX index or the volatility index, but it's often known in the popular press as the fear index. So I want to spend a little bit of time talking about it because I think it's very important and informative to put things into perspective. Here's a chart that shows in green. This is the VIX level. The VIX actually started as an index around 1993, but the CBOX that organizes the trading of this VIX did some back testing back to 1986. So the green represents the VIX as well as some back testing of it. The red represents my recreation of a proxy for what the VIX would have looked like prior to 1986, all the way back to 1927 and 1928. And notice that, and I'll talk about some of these points where we have cut the chart off because just for scaling purposes. So what is the VIX all about? Well, if you are an investment geek, the way to explain the VIX is this is the implied volatility of the Black-Scholes option pricing model for call options on the S&P 500. If that made no sense to you, here's another take on it. If we have mathematics geeks, then another way of looking at the VIX is it's a measure of the standard deviation or the expected standard deviation of the stock market. For the rest of us, what the VIX represents is market participants' expectations in the next month or the next several months of how volatile the market is expected to be. So to put things into perspective, the long run average of the VIX is 20. So what does that mean? If, and this is a big if stock returns were normally distributed, and I think most of us are aware of what this notion of a normal distribution or a bell curve. So if we think of that as an approximation for now, and if we think of a long-term average of stock returns of say 10%, that implies that we would expect going forward next year, without any other information, we would expect that stock returns would be 10% plus or minus 20% 2/3 of the time. So that's what the normal distribution implies. So the higher that number, the higher that anticipated standard deviation, then the higher the range of our expectations. And if we focus in particular on the downside, that's where the fear aspect comes into play. Then we're expecting much more volatility. So based on the green bars, I took a look at the average of and each of the whole time series of the VIX and the backdating of the VIX to take a look at what would be the high end, in particular the highest 5% of what the VIX has hit, and it turns out that that's a number of around 34. So to put things into perspective, recently what we had occurring last month, March 16th, the VIX hit an all-time high of 82. So that's a fantastically high number compared to this average of 20. Back in the financial crisis, it hit, then was an all-time high of just under 80, around 79. Now, as I mentioned, the VIX started in 1993. Had the VIX been around in October 1987, using the same calculation, around October 19th, 1987, the VIX would have hit an all-time high of 150. So just to put that into perspective. And had the VIX been around during the Great Depression, at a level similar to the highs that we saw now. So while these are not common events, we can see that there have been other times throughout history when that fear factor has been as high today or recently as high as it's been in the past. More recently, just to put it in perspective, that VIX has declined, and it's hard to tell from this chart, to where it is this morning is in the low 40s. So it's still above that 5%, that magic number of 34, but it's come down pretty substantially from that. So let's with that as some background, the other thing I just want to show before we tee up the next question, the next quiz. Take a look at what the market has done during that time period. So with all the volatility, we still see this upward trend on the market. Okay, so with that as some background, Sean, let's tee up the next quiz question.
Okay, so we will launch the quiz now.
Okay,
Just before you explain that, you may be touching your microphone with a sleeve or your jacket. Maybe there's like a little bit of feedback in the chat that you might be hitting your microphone.
Okay, we'll try to keep that.
So the quiz is live.
Thank you. Okay, so let's suppose that tomorrow I knew that the VIX was going to be above 34, so this 5% range. So today, in anticipation of that, I got out of stocks. And I stayed out of stocks until the VIX was below that magic number of 34. How do you think that would compare to a buy and hold strategy? A, I would underperform. B, it would be roughly the same within a percent or so. Or C, I would outperform. So take a quick gander at that to see what you think is the correct answer. And then Sean, you can show us the results.
Okay, we'll leave it open for another couple of seconds. Only about 50% have voted, a lot hedging their bets.
Come on now, you got to keep going with the quiz, regardless of how you did in the first question.
Okay, here are our results. 64% think they would underperform.
Well, it turns out that the minority, the 11% C, the correct answer is C, you would have outperformed. Okay, so let's try to put that into perspective here, and I'll show you on the next chart if we can close that up, Sean. Here's where it looks like some easy money. So if I knew that today the VIX was going to be over 34 and I got out of the market, I would have substantially outperformed. The return, the cumulative return since 1986 would have been 318, and that compares with 255 for a buy and hold strategy. That's where we're at. That's where we're at with that one. Now let's tee up the next question then, Sean.
Ready to go.
Okay. So now I'm going to change the question very slightly. Okay. Suppose that I knew today that the VIX was over 34. Okay. So given that I have that information today, now I'm going to act differently tomorrow. So the VIX has now gone above 34 today. I haven't been able to take any action, but tomorrow I'll get out of the market. And I'll stay out of the market until the VIX goes below 34, and then the next day I'll get out of the market. So I'm slightly changing it just by a day. A, would I have underperformed? B, roughly the same? Or C, outperformed a buy and hold strategy?
Okay, we'll leave this open for another couple of seconds. And with 426 votes, 68% think they would underperform.
And the 68%, and it looks like people stuck with their original answer, perhaps, those 68% would actually be correct. So good job to the majority there. So let's close that up and let me tee up the next chart and explain what's going on. So this is the previous question, and this is the new question, what we had here. So notice how much of a difference that one day made. So now our cumulative return is below what the buy and hold strategy is. We would have had 255% versus 318%. So the key message from these two charts is that the VIX can rapidly increase, and that can have a huge impact on your investment performance. And so if we take a look at this VIX index, and really the fear index is really a misnomer because volatility cuts both ways. Another way to interpret these differences is that unlike a normal distribution, what we actually observe in the stock market are what are known as fat tails. So we see many more highs and many more lows or drops in the market than we would expect from a normal distribution. So what that means is that if you are out of the market in a very volatile time, you are not only going to miss on some of the major drops, but you're going to miss on some of the major rebounds. To put it in perspective, the average daily return on the market is about 0.3%, 0.3% per day. The kind of returns that we've seen some major drops in March and April of this year. But here's some of the increases that we have seen on a daily basis in March and April. 4.2%, 4.6%, 4.9%, 6.0%, 6.2%, 7%, 9.3%, and 9.4%. If stock returns were normally distributed, each one of those occurrences would be expected to occur only every couple of years. So to have those 9 occurrences in a very short period of time, we would only expect that once in let's say 20 years or so. So this tells us something, and so this is a cautionary tale in terms of being out of the market. There's no easy way to trade off of the VIX. Back to you, Mark.
Yeah, Steve, I know we said we wouldn't veer too far out of commentary on the markets today, but I do want to shift a little bit to the economy. Lots of talk of recession, some talk of depression. Actually, are we in a recession now? And what's the concern level we should have?
Sure. So short answer is almost certainly yes, we are in a recession now. In terms of concern as it ties into the stock market, I would say not necessarily. So again, let's take a look at history and let's provide some background information. This chart shows us U.S. recessions from 1927 through 2019, and the recessions in Canada would be pretty similar to what we see here in terms of the U.S. On March 26th of this year, the Federal Reserve Chairman, Jeremy Powell, was quoted as saying, and it's probably an understatement, "We may well be in a recession." That's when the jobless claims shot up to 3.28 million from 282,000 the previous week. He went on to say, "But I would point to the difference between this and a normal recession. There's nothing fundamentally wrong with our economy. Quite the contrary, we are starting from a very strong position." What's also interesting is that just 1 week ago, on April 8th, the Wall Street Journal did a survey of economists, and 96.4% of those economists felt that the U.S. would be in a recession in the next 12 months. My takeaway from that survey is, what about the other 3.6%? That means that I think either they're really ill-informed or they're extremely optimistic. I'm not sure which. But what I want to do here is focus on tying in this economic activity to the stock market. So Sean, let's tee up our next quiz. And while I'm doing that, just another tidbit. The IMF came out with a report just yesterday, April 15th, predicting that in 2020, the global economy would be in a recession and see a contraction of 3%. To put it in perspective, in 2008, 2009, the global economy dropped by 0.1%. So a huge different order of magnitude. Okay, next question, Sean. Okay, so we want to tie in the relationship between the stock market and the overall economy. What is that relationship? A, is it that stock prices tend to lag the overall economy as measured by GDP? B, do stock prices tend to coincide with overall economic activity? Or C, do stock prices tend to lead overall economic activity? So let's see. Please keep voting. Don't be discouraged if you got the first few questions wrong. This is your chance at redemption. Only a 1 out of 3 chance, or only a 2 out of 3 chance of getting it wrong. So the odds are in your favor compared to the other questions.
All right, so that said, and with some guesses thrown into the mix, we will end polling at 73%. And we have 70% answering C.
And 70% is the correct answer. So good job on the redemption there. So we'll just close that up. And this next chart then shows you the relationship between the stock market and these recessions. And you can see, it's pretty consistent that we see the stock market peaking prior to a lot of these recessions. And that makes sense because if we look at what stock prices represent the market's expectations right down to a company by company level, the expectations of the profitability or the ability of that company to generate cash flows. And so the market's not always right, but these are given information as a particular point in time. This is what the market is expecting. And on average, the expectations, the stock market tends to peak roughly 6 months prior to the peak in economic activity. Now, notice that the market doesn't always get it right. So if you look at these, at the circled points here, what we can see is times when the market dropped, and yet there was no pending recession. And so this led to the quip by Paul Samuelson, Nobel Prize winning economist, who in a 1966 Newsweek article quipped that the stock market has predicted 9 out of the past five recessions.
If we think about a recession, Stephen, let's just assume that we're in one. How do stocks tend to perform during recessions?
So, Mark, you might actually be surprised. Not as bad as you might think. So, the green bars show us the returns of the stock market during these recessionary periods. And if we take a look on the right-hand side, we see the averages, the mean and the median, are in the 3 to 5% range. So not too bad. The blue bars represent from the start of the recession to the low point in the market. And so we can see those averages are in the 19 to 23% range. The red bars show us from that low point to the remainder of the recession what the returns are, and so we see this pretty strong bounce back. And again, that's in anticipation of what the pending recovery might be. So it's interesting. If we are in a recession, which we probably are, if we compare what the S&P 500 level was at the end of February, so before entering recession, and if and this is a big if March 20th so far remains the low point during this probable recession, that decline has been around 22%, so right in line with what these averages are.
Interesting. I mean, lots of comments and questions in the Q&A. We'll get to some of them later about, whether in fact this is, isn't this different or is this different now? But the data doesn't so far support that. How long do recessions tend to last?
So if we take a look at the length of recessions, so the average recession that we see start to end are the green bars, roughly around a year, 11 to 15 months. Of course, the Great Depression is a huge outlier, which lasted. This is in months, so lasted about 5 years. The red bars show the duration between the start of the recession and the low point in the stock market. And so what's curious about that is that on average it's between 6 to 9 months on average between the start of a recession and the low point in the market. What's curious and fascinating about the current situation, and again, this is a big if, assuming we've hit a bottom in terms of markets and we have this recovery. The start of the recession, assuming it happened round numbers on March 1st of 2020, then it only took a month to get to that low point. And so that's pretty dramatic. There have been other times in other situations where there have been pretty quick drops. And the good news there is that during those times of pretty quick drops, the recessionary time has been fairly short.
So fair enough. I think, you know, the skeptic in me, and I think it's in some of, so you can see it in some of the comments and questions, is, you know, the catalyst this time is different. The catalyst is a pandemic. That's not like we saw, you know, 10 and 20 and 30 years ago. So, you know, from a historical perspective, we've seen this before. Do you have any commentary on what happened a century ago with, you know, one of the world's worst pandemics and what the impact was?
Sure. So again, here's where I think it pays to have a bit of a history lesson and put things into perspective, because it will inform what's happening here. I just want to start off by really setting the record straight in terms of what this 1918-1919 influenza pandemic has been called. It's really a misnomer to call it the Spanish flu. Historians actually aren't clear where it originated. It may have been China. It may have been France, and in fact, it may even have been in Kansas where it started. But this is an interesting parallel to today. We hear a lot about fake news. Well, back a century ago, fake news was what was happening. This was a time when the Great War was going on, and what many countries did that were involved in the war is they suppressed information, in particular information on how bad the pandemic was, in order to because this was spreading through armies tremendously, and so they didn't want to hurt the morale of their armies, as well as the people in their country supporting the war effort. Spain was a different case. Spain was neutral during the First World War, and so they had nothing to hide. So they accurately reported what their numbers were. So disproportionately, it looked like Spain was being hit tremendously hard by this pandemic. To make matters worse, the king of Spain, Alfonso XIII, came down with the flu. He survived, but that made it worse. One last little tidbit is that what did the Spaniards call what is known as the Spanish flu? Well, they felt it originated in France, so to them it was called the French flu.
Of course it was, yeah.
So just to put things into perspective, and there was an interesting report that was put out by the Federal Reserve back in 2007 that looked at the pandemic. The low numbers are that probably 40 million people worldwide died, to 675,000 in the U.S. alone, which was about 0.8% of the population. There's not a lot of economic data, really good economic data, but anecdotally, companies reported sales declines of 40 to 70%. Wage growth was actually higher in places where there was a higher mortality rate. But these early charts show, and I think this is informative for today, early charts show that there were various spikes in terms of the pandemic. In particular, this chart here shows us that there were 3 waves, and it was actually the second and the third wave that were the most severe waves. So Sean, if you can tee up our 5th quiz question. So we want to put it in perspective. So what do you think was happening with the stock market during these particularly bad waves of during the 1918-1919 influenza pandemic? A, do you think that stock prices decreased during each of the waves? B, stock prices increased in 1 and decreased in 2 waves? C, stock prices increased in 2 of the 3 waves? Or D, stock prices increased in all 3 waves? Again, if you don't know, take a guess. I didn't know before I took a look at the data.
Looks like not a high degree of confidence, but we'll take what we've got. And option C has narrowly edged out the others at 34%.
So option C, I can't, oh, there we go, Sean. So option C, well, it turns out that the least popular answer, D, is the correct answer. These sound like trick questions. I'm sorry for that, but if you're doing really well, then that's fantastic. So let's put it into perspective. So this chart shows us the Dow Jones Industrial Average between 1916 and 1919. And the shaded areas show us the influenza waves. And so you can see from the beginning to the end of each of these three waves, the stock market increased. Now, clearly there were a lot of confounding effects here because this was the tail end of the First World War. So we have to take that into account. But the takeaway from this is that pandemics, at least this pandemic, didn't necessarily have a negative impact on the stock market.
Can you talk a little bit about more recent times, maybe SARS?
Sure, just a bit of background. The SARS outbreak happened in 2002. It was first identified in China. Over 8,000 people were infected across 29 countries. The mortality rate was extremely high, almost 10%. And it was a scary pandemic. Canada was hit relatively hard, Toronto in particular. Many of you Torontonians will remember perhaps Mel Lastman and some of his comments going on CNN saying, talking about the World Health Organization, who is who. They don't know what they're talking about. So again, some parallels perhaps to today. But throughout all of this, we see that the stock market initially took a hit and dropped by about 11%. But then by the time the WHO declared that SARS was contained, in July of 2003, markets were up by 10%. And if we take a look further to 2004, when the WHO reported that there were no more cases in China, in fact, from start to end, in over 18 months, the market was up by 20%.
Hey, Steve, just to know, we still got a fair amount of feedback coming off your mic. I know we talked when we prepared for this about, is this a pandemic or is this more analogous to fighting a war? So I know you've looked at World War II. Can you just talk a bit about that?
Sure. So let's take a look at what happened during the Second World War. During the Second World War, we see that there were some major drops. In particular, we see a drop when Germany attacked Western Europe. And so from between the time when Hitler invaded Poland on September 1st, 1939, to the low point in April of 1942, the market was down by 33%. However, by the end of the war, when Japan surrendered, overall the market was up by 39%. And so what's curious about this is that the average annual compound return over that time period was 5.6%, which is perfectly in line with that long-term average.
I mean, I guess you could talk about this as a bear market. We were in one when the stocks dropped by more than 20% from their peak, kind of like World War II. We've seen other bear markets. Can you just put kind of bear markets in a historical context? Sure.
So in addition to the bear market in World War II, we've seen a number of them. We see there was obviously the Great Depression, 1973-74. We had the oil shock, 1980-82. This picture of Paul Volcker, the chair of the Federal Reserve, who was fighting inflation, which led to a major recession, but also knocked out the double-digit inflation. October 19th, 1987, the most dramatic to this day, one-day drop in stocks of almost 23%. And then on the right-hand side, we see some of the more recent and probably more memorable to our audience events, the dot-com bubble, the global financial crisis, and where we are right now. So let's tee up our second last quiz, Sean. So clearly the Great Depression bear market was the greatest drop. It was an 89% drop. Which bear market of the remaining 5 was the next most severe? Was it A, the oil shock in 73, 74, B, the inflation recession 80, 82, C, Black Monday 87, D, the dot-com bubble 2000, 2002, or E, the global financial crisis 2007, 2009? Hopefully everybody's hanging in there and still answering some questions.
Still getting lots of answers.
Glad everyone's keeping at it.
And 65% have voted. We'll end the poll here. Narrowly Black Monday.
Oh, just edging out the global financial crisis. Well, it's actually E, the global financial crisis, that had the greatest drop. So let me put things into perspective here. So this chart shows us the various financial crises. Sean, if we can close up the poll results there. So you can see the Great Depression was by far the most dramatic. I'm going to hone in, and the scale shows us the number of trading days. So let me hone in a little more. So this is in the first 2 years, and the red line shows us where we are again. So what's kind of fascinating about this is that what we see here is that this is certainly the quickest dramatic drop in the market. The only two that are closer, the blue line here is the Great Depression, and the purple line is Black Monday. And what's fascinating is that both of those two had very different outcomes, as we know. The Great Depression lasted for about five years, and so what looked like a local drop, and we see this recovery, turned out to be a false one because the market kept dropping. Very different outcome for Black Monday. It was a very short blip, and was one of the fastest of the recoveries. And so what we're facing now is very different. And so to put that into perspective, it could be, if it's a true rebound, then this could be more like Black Monday. But if it's a false rebound, perhaps it's something worse.
What was the scale of the losses and the length of the recoveries?
So if we take a look at the length of the recovery, the blue bars show us the drops in the market. So where we are right now, again, assuming that where we are is the low point at 33%, where we are right now is sort of right in line with other drops, except for the Great Depression. So somewhere between 28%, 27%, and 56%. The shortest recoveries have been around 2 years. And again, outside of the Great Depression, which took 25 years to get us back to the level that we were at, it's usually been in the 2 to 8 year range.
One of the questions that's coming up a lot in the Q&A is trying to get your take on leverage buying opportunities. This is a buying opportunity. So stocks look cheap now. Is this a good time to buy?
Well, that's a great quiz question. So Sean, let's tee up our last quiz question. It's a true false. So you got a 50-50 chance here. If you haven't had any success yet, take a guess on this one. So by common valuation metrics relative to long-term averages, stocks are cheap now. True or false? True or false? Are stocks cheap now?
Looks like pretty well everyone's willing to take a guess on this one.
Perfect.
With 70, almost 80% of people having voted. We'll close the poll. It's pretty close though. Are stocks cheap right now? Unfortunately, for the majority, the answer is false. Got you one last time. Sorry about that. So here's where we can put things into perspective in terms of what's known as the CAPE
ratio. This is an index that was created by Nobel Prize winning economist Robert Shiller. All these data are from his website, so you can go and check it out then. What he's done is he's taken a look at the current level of stock prices relative to a 10-year average, a moving average of earnings. So it's a price earnings ratio, but adjusted for business cycles. Where we are right now is at a level of 23. The long-term average is 17. So stocks are not cheap now. A few months ago, the CAPE was at a level of about 33 times. And the only two other times that it was higher than that was in 2000 and 1929, both which were followed by some major drops. So the message here is that even without this pandemic, stocks were not cheap and perhaps were ripe for a correction.
So Steve, we're coming up on time. Maybe you could wrap up with some key takeaways, and then we'll try and get to at least a couple of questions that have come in.
Sure. So here are the key takeaways from today's session. So first of all, stocks for the long run have paid off. So the average return over a long period of time has been in the 8 to 9% range, and despite all the turmoil recently in the markets, we're still on this long-term trend. Markets have been and will always be volatile. The VIX has been off the charts recently, but it's coming back more. There's no easy money to be made. Be very cautious of getting out of the market during a volatile time because you might miss the major upswings. Stock declines are naturally associated with economic declines and recoveries. And so that's where we have the stock market reflecting expectations of what the economy is going to do. Pandemics, wars have take a tragic human toll, but not necessarily an economic toll. Markets are anticipating what's expected to happen in the economy. The markets don't always get it right, but think of the market today expecting what will be happening, let's say, out in October and beyond. That being said, each bear and bull market is unique. So there is a huge range in terms of what we might expect and time period in terms of what the recovery is. And the last thing is to pay attention to history. Keep calm and carry on. My recommendation is that if you have an app that tracks your investment performance or your retirement performance on a daily basis, get rid of that app. I like to only take a look at my investment portfolio, my retirement portfolio once a year. I think that's all that you need. Otherwise, if you have faith in the economy long term, keep calm and carry on.
Okay, that's great. I think that's a good sort of theme from all of this from you. We do have a few minutes left. If you're okay with it, I just want to try and bank through a few questions from the Q&A. So, this is the first one, and it's come up a few times. It's one I actually asked you the other day. So it's hard to imagine that earnings aren't down this quarter, right? A lot, maybe as much as 50%. If earnings are going to be down, are we expecting further market declines?
And that's a great question, because companies are just starting to report earnings now, and earnings will continue to be reported, and they'll be dismal for most, but not all companies, because there are some sectors that are doing really well. One of the best performing stocks, as I think people know, the technology we're using now, Zoom has done tremendously well as an individual stock, and certain sectors are doing better, others are doing terribly. It's important to keep in mind that the market is incorporating expectations. So a lot of the bad news that is coming out now has already been anticipated in the market. So these dismal earning reports, all that will matter from the market's perspective, are they better or worse than the market is already expecting now. So even companies reporting earnings down by 50%, if it's only for the next quarter or even the next 2 quarters, we can expect some huge economic recoveries and therefore stock market recoveries as well.
We've got some folks looking for stock tips from you, Steve, but we'll skip those ones, and maybe you can take them offline. Quite a few questions about bonds, and what's the relationship between the stock market and the bond market, and do you have any comments on bonds right now?
Sure. So bonds, unlike the stock market, are really driven by interest rates. For those who have been in my classes, you'll know this relationship. When interest rates go down, bond prices go up. So what we have seen, and this really goes back to the early 1980s, when interest rates, including mortgage rates, were over 20%. Since then, we've had this long-term decline in interest rates, and that's really fueled the bond market in general. So with interest rates, if we think that interest rates still have a little bit ways to go, although even long-term US yields are in the 0.6, 0.7% range. We don't have time today, I think, to talk about the possibility of negative interest rates, but if interest rates still have a little bit ways to go downward, then that's good news for bonds in general. Now, here I'm talking about government bonds.
Yeah.
If we're talking about corporate bonds, then that's a different story, because now we have to add on this risk premium. And inevitably in recessions, we can anticipate that there will be this increased risk premium, which means potentially higher interest rates that companies are facing, which means lower corporate bond prices. So I think it really, there'll be this dichotomy between government bonds and corporate bonds.
Well, I want to do one more. There's a good question here, historical context and where we are now. It's from Lindsay Arson. I apologize if I mangled your last name, Lindsay. And so her question is kind of about the times we live in. So we live in times where everyone knows everything, and we've got online trading platforms, access to information at the speed of light. Does that affect how you look at this crash versus previous ones?
Not really from that perspective, because here we're not talking about day trading, or we're not talking about micro trading. What we're talking about here is the market, and this has always been the case. The market has to digest information. Today, the kind of information which is different from other time periods, is it's a lot of medical information, and trying to then anticipate how this pandemic is going to play out, how different countries, and even if you look at the US, how 50 different states are going to be reacting. So yes, there's a lot of instant information. Some of it, perhaps a lot of it, which is noise. So there are only, I think, a smaller amount of really important information that the market has to digest. And so I don't think that has changed now versus other time periods.
Okay, that's fantastic. We're up against it on time. Sean, can you just remind everyone where they can find the recording, what we're going to do in terms of follow-up, et cetera?
Absolutely. So saw a few people asking in the chat and in Q&A whether the materials and recording would be available. They will be up on the Ivey Academy YouTube channel within about an hour, as well as our website on the Ivey Academy blog. You'll also get an email follow-up if you registered today with all of that. So keep an eye out.
And Steve, we may lean on you just a little bit more because we had so many questions that came in that we didn't get to, probably 60 or so questions. I'll try and get them done into some sort of thematic, spin it back to you. And if you could maybe provide some written comments, we'll try and push out a follow-up too. So just wanted to say thank you. Thanks for investing all the time in preparing for this. I know you were checking the markets and checking numbers, regularly over the last 2 weeks, just to make sure you were really current, and very, very insightful today. Thanks for spending the time. Appreciate it.
My pleasure.
Thanks to everyone in the audience for tuning in again, and we'll see you next time. Cheers.
Hey, Mark, I'm just sort of getting you up here. Oh, there we go. Yeah.
Yeah, I think Sean turned us down. I just wanted to do a real quick debrief. How do you feel about that?